Preparing for a FP&A at Charter interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a company like Charter? FP&A connects Charter's operating decisions with financial outcomes. I would help build budgets, refresh forecasts, explain variances, and provide leaders with clear recommendations. In a broadband and entertainment business, that means linking subscribers, pricing, churn, service costs, content expense, and network investment to revenue and cash flow. I see FP&A as more than reporting historical results. It should identify emerging trends early and help management allocate resources toward profitable growth while protecting financial flexibility. While answering, focus on budgeting, forecasting, performance analysis, decision support, and translating operational metrics such as subscribers, churn, revenue, expenses, and capital spending into financial implications. Question 2. Walk me through how you would build an annual budget for Charter. I would begin with historical actuals and a clear operating driver model. For Charter, I would forecast subscribers, gross additions, churn, pricing, product mix, service costs, programming, labor, and network investment. I would meet business leaders to understand initiatives and challenge unsupported assumptions, then consolidate schedules into income statement, balance sheet, cash flow, and capital views. After sensitivity testing, I would present the budget with key risks, version control, and measurable owners for each assumption. Make sure to cover operating driver assumptions, collaboration with business owners, historical analysis, revenue and expense schedules, capital planning, review iterations, and documentation of assumptions, risks, and ownership. Question 3. How would you forecast revenue for a broadband and video business? I would use a driver-based forecast rather than simply applying a growth percentage. I would project beginning subscribers, gross additions, disconnects, and ending subscribers, then estimate average revenue per user by product and customer segment. I would incorporate promotional roll-offs, pricing actions, bundling, seasonality, and one-time items. Finally, I would reconcile the operational build to the general ledger and prior forecast, investigate differences, and explain whether changes reflect volume, price, mix, or timing. In your answer, talk about subscriber counts, gross additions, churn, average revenue per customer, product mix, promotional pricing, seasonality, one-time items, and reconciliation to reported revenue. Question 4. Which KPIs would you monitor in Charter's FP&A function? I would monitor KPIs that explain both performance and future value. Core measures would include revenue growth, adjusted EBITDA, margins, broadband and video subscribers, churn, ARPU, gross additions, customer acquisition cost, capital spending, and free cash flow. I would also track forecast accuracy and variance closure because a good KPI framework supports better decisions. Importantly, I would avoid viewing metrics in isolation. Subscriber growth with weak economics may be less attractive than disciplined retention and profitable customer mix. Be sure to mention financial and operational KPIs, including revenue growth, EBITDA margin, subscriber trends, churn, ARPU, customer acquisition cost, capital intensity, free cash flow, and forecast accuracy. Question 5. How do you analyze a budget versus actual variance? I start by quantifying the variance and comparing it with the forecast, budget, and prior year. Then I separate price, volume, mix, timing, foreign or market effects, and one-time items where relevant. For Charter, a revenue miss might reflect subscriber churn, lower ARPU, or delayed pricing, while an expense variance could reflect programming timing or project acceleration. I validate the data with business owners, determine whether the issue is recurring, and update the forecast or action plan accordingly. Focus on quantifying the variance, separating price, volume, mix, timing, and one-time effects, validating source data, engaging business owners, identifying corrective actions, and communicating materiality clearly. Question 6. What is the difference between a forecast, budget, and long-range plan? A budget is the formally approved operating plan for a defined period and establishes accountability. A forecast is management's latest estimate of what will actually happen, incorporating current results and updated assumptions. A long-range plan extends several years and focuses more on strategic direction, investment, competitive dynamics, and capital needs than monthly precision. I would use all three together. The budget measures execution, the forecast supports near-term decisions, and the long-range plan frames sustainable value creation. Make sure to distinguish the budget as an approved operating target, the forecast as a current expectation, and the long-range plan as a strategic multi-year view with different detail and refresh cycles. Question 7. How would you forecast subscriber churn? I would segment churn by product, tenure, geography, customer value, and acquisition channel because averages can hide important behavior. I would analyze historical trends alongside pricing changes, service reliability, competitive offers, seasonality, and promotional expirations. For example, a pricing increase may produce different churn among broadband-only and bundled customers. I would build base, upside, and downside cases, monitor leading indicators such as complaints or cancellations, and reconcile the forecast monthly to actual disconnects. In your answer, cover historical cohorts, customer tenure, product and geography, pricing changes, competitive pressure, service quality, seasonality, scenario analysis, and reconciliation against actual disconnect data. Question 8. How would you evaluate a proposed pricing increase? I would evaluate the pricing increase through both revenue and retention economics. First, I would estimate the customer base affected, effective timing, incremental ARPU, and expected churn response by segment. Then I would compare additional revenue with lost contribution margin, customer service costs, competitive reactions, and implementation expense. I would run sensitivities around churn and adoption, assess customer lifetime value, and present the expected EBITDA and cash flow impact rather than treating gross price uplift as the entire benefit. Focus on incremental revenue, expected churn, ARPU, customer lifetime value, competitive response, implementation timing, customer communication, sensitivity analysis, and effects on EBITDA and free cash flow. Question 9. How would you build a capital expenditure forecast for Charter? I would build CapEx from project-level schedules rather than applying a blanket percentage to revenue. The forecast would distinguish network expansion, maintenance, customer equipment, technology, and other categories, with milestones, vendor commitments, expected in-service dates, and cash payment timing. I would coordinate with engineering and operations to validate scope and timing, then model depreciation impacts separately. Monthly reviews would compare approved projects with actual spend, identify slippage, and update free cash flow expectations. Be sure to mention project-level planning, network expansion, maintenance, customer equipment, timing, vendor commitments, capitalization policy, depreciation implications, cash flow, and variance monitoring. Question 10. How do you assess whether a cost-saving initiative is financially attractive? I would establish a documented baseline and define exactly how savings will be measured. Then I would separate gross savings from implementation costs, one-time benefits, recurring benefits, and timing effects. For Charter, I would also test whether a cost reduction could affect network reliability, customer service, churn, or growth. I would assign an owner, include the initiative in the forecast only when evidence supports it, and track realized savings against the original business case through monthly variance reporting. Talk about a credible baseline, implementation costs, recurring versus one-time savings, timing, operational risks, service quality, ownership, measurement methodology, and confirmation through actual results. Question 11. Tell me about a time you improved an FP&A reporting process. In a prior role, a monthly variance package relied on several manual spreadsheets and took nearly a week to complete. I mapped the process, standardized account mappings, created a controlled data extract, and built a dashboard that highlighted material variances and ownership. Review time fell from 5 days to 2, and leaders received more consistent explanations. I also documented the process and added reconciliation checks, so the improvement increased both speed and confidence rather than simply making the output look better. While answering, focus on the original inefficiency, your analysis, stakeholder collaboration, automation or standardization, control improvements, measurable results, and how you sustained the new process. Question 12. How would you explain a complex financial result to a non-finance executive? I would lead with the conclusion, quantify the impact, and explain the 2 or 3 business drivers that matter most. For example, I might say revenue is below forecast by $12 million, primarily because subscriber losses offset pricing gains, while costs remain on plan. I would then explain whether the issue is temporary or structural, outline the recommended response, and show a simple bridge or trend. I would avoid accounting jargon and invite questions on assumptions or actions. Make sure to cover the headline conclusion, business drivers, financial magnitude, comparison with plan, implications, recommended action, visual simplicity, and adjustment to the executive's level of detail. Question 13. What would you do if an operational leader challenged your forecast assumptions? I would first understand the leader's operational evidence and clarify which assumption is disputed. Then I would compare historical performance, current indicators, and external information, making sure we use consistent definitions. If uncertainty remains, I would present a range of scenarios and show the financial impact of each rather than arguing over a single number. I would document the agreed assumption, owner, and trigger for revisiting it. Strong FP&A partnering requires constructive challenge without turning disagreement into conflict. In your answer, emphasize listening, fact-based challenge, shared definitions, sensitivity analysis, scenario ranges, documentation, escalation when necessary, and maintaining a collaborative relationship. Question 14. How would you create a rolling forecast? I would maintain a consistent forward-looking horizon, such as the next 12 months, replacing completed periods with actual results as each month closes. The model would use operational drivers for subscribers, ARPU, churn, labor, programming, CapEx, and cash flow. I would update only assumptions that changed materially, document the reasons, and include upside and downside cases. Each cycle should learn from prior forecast errors, with clear ownership and a manageable review cadence for business partners. Focus on a consistent horizon, driver-based updates, actual to forecast replacement, assumption governance, scenario analysis, variance learning, stakeholder cadence, and avoiding unnecessary administrative burden. Question 15. How do EBITDA and free cash flow differ, and why do both matter? EBITDA measures operating earnings before interest, taxes, depreciation, and amortization, so it helps compare operating performance before financing and non-cash depreciation effects. Free cash flow reflects the cash left after operating needs, capital expenditures, taxes, interest, and working capital movements. For Charter, EBITDA shows the strength of the customer and network economics, while free cash flow captures the cash required to maintain and expand infrastructure. I would analyze both, especially when evaluating investment capacity, leverage, and shareholder returns. Be sure to distinguish operating profitability from cash generation, explain depreciation, capital expenditures, working capital, interest, taxes, and why Charter's capital intensity makes cash conversion important. Question 16. How would you perform a scenario analysis for a recession or competitive disruption? I would identify the variables most exposed to the scenario, such as gross additions, churn, ARPU, bad debt, labor costs, programming expense, CapEx timing, and financing costs. I would build base, downside, and severe cases, clearly documenting the assumptions and incorporating realistic management actions. For example, delayed discretionary CapEx may protect cash but could affect future growth. I would present EBITDA, cash flow, liquidity, and covenant implications, along with early warning indicators that determine when management should act. In your answer, discuss identifying key sensitivities, changing operating drivers, modeling management actions, creating base, downside, and severe cases, assessing liquidity, and communicating probabilities and triggers. Question 17. What financial controls are important in an FP&A process? Important controls include clear ownership, restricted access, version control, documented assumptions, reconciliations to the general ledger, and review of manual adjustments. I would maintain an audit trail for changes, use standardized templates, validate source data, and require approval for material assumptions or overrides. Segregating preparation from review reduces error risk. In a recurring forecast, I would also perform reasonableness checks against operational metrics and prior periods, because a technically balanced model can still contain economically incorrect inputs. Focus on access controls, version management, reconciliations, documented assumptions, approval workflows, segregation of duties, audit trails, data validation, and review of manual adjustments and material judgments. Question 18. How would you use Excel and data visualization tools in this role? I would use Excel for transparent driver-based models, scenario analysis, reconciliations, and ad hoc investigation, applying tools such as structured formulas, pivots, Power Query, and sensitivity tables. For recurring reporting, I would use visualization tools to show trends, bridges, KPI performance, and forecast changes clearly. I would always reconcile dashboard outputs to source systems and preserve definitions. The objective is not a complicated model, it is a controlled, efficient analysis that helps leaders make faster and better decisions. Mention advanced Excel modeling, efficient formulas, pivot tables, scenario tools, data validation, automation, dashboard design, source reconciliation, and presenting only decision-relevant information. Question 19. How would you investigate a sudden decline in broadband revenue? I would first confirm the decline is real by reconciling reported revenue, billing data, and timing differences. Then I would decompose the change into subscribers, churn, gross additions, ARPU, product mix, pricing, promotions, and geography. I would compare actual trends with forecast and prior year, speak with sales, marketing, and operations, and check for billing or system issues. Once the root cause is isolated, I would quantify its recurring impact and recommend a forecast adjustment or management action. Be sure to cover data validation, subscriber volume, churn, gross additions, ARPU, pricing, mix, promotions, billing timing, geography, competitive factors, and concise escalation of root cause. Question 20. Why do you want to join Charter as an FP&A analyst? I am interested in Charter because its scale and infrastructure investment create a meaningful FP&A environment where operating decisions directly affect revenue, margins, and cash flow. The business combines recurring customer economics with competitive, technology, and capital allocation questions, which is analytically attractive to me. I would bring strong modeling, attention to detail, and a collaborative approach to forecasting and variance analysis. I also want to grow by partnering closely with operations and helping leadership make disciplined, data-driven decisions. In your answer, connect Charter's scale, network investment, evolving connectivity market, analytical complexity, cross-functional exposure, learning goals, and specific ways you would contribute to disciplined planning. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.